Hi. I'm Gary. Cryptocurrency trading. Simplify cryptocurrency. Buying and selling digital currencies, a beginner's guide to cryptocurrency trading. Cryptocurrency or crypto trading refers to the practice of gambling on the price changes of cryptocurrencies using a contract for difference, CFD, trading account or purchasing and reselling the underlying coins on an exchange. Leveraging your trades with cryptocurrency, however, increases both profits and losses because your overall investment size still determines your profit or loss. Trading in cryptocurrency options refers to the derivative financial product, in this case the underlying cryptocurrency, whose value is derived from the price of another asset. It's crucial to have a thorough understanding of the assets and technologies involved in crypto trading before even considering getting started. Trading cryptocurrencies may be challenging, encompassing a multitude of elements and needing understanding, just like trading stocks and other financial markets. The largest cryptocurrency is Ether, and all other cryptocurrencies that are not Bitcoin are referred to as altcoins, ETH. The tactics for trading cryptocurrencies will be covered in this guide, along with information on platforms and tools for trading cryptocurrencies, trade components, trading styles, and the significance of technical and fundamental analysis in developing a thorough trading strategy. How to trade cryptocurrency for beginners. There are many different methods for trading cryptocurrency. One must have sufficient knowledge of cryptocurrencies before they can begin trading them. Additionally, it's important to be aware of the hazards involved in any local regulations that might be relevant before making decisions. Sign up for a cryptocurrency exchange. If you don't already hold cryptocurrency, you will need to create an account with the crypto exchange. You can watch my previous videos on cryptocurrency exchange, on how to open an exchange account and how to fund it. Pick a crypto to invest in. Bitcoin and Ether are the two cryptocurrencies that most cryptocurrency traders invest in. However, because big cryptocurrencies move more reliably than smaller altcoins, trading using technical indicators is conceivable. A lot of cryptocurrency investors invest some of their capital in altcoins. Smaller and mid-market cap cryptos have a larger upside potential despite being riskier than large market cap cryptos. Start trading. If you're looking for an automated cryptocurrency trading method, there are some exchanges that support that kind of trading method or a trading program. The procedure used by cryptocurrency trading bots is intended to give you the most returns in accordance with your investment goals. With the help of automatic trading for cryptocurrencies, you may quickly make money, keep your coins, or diversify your portfolio in a conservative, neutral, or aggressive manner. You might even consider actively trading cryptocurrencies on some websites while using trading automation on others. Store your cryptocurrency. You'll need to keep your money on the exchange if you're actively trading BTC in order to have access to it. For instance, if you plan to acquire cryptocurrencies to hold for the medium to long term, you should do that with cryptocurrency wallets. There are two different kinds of Bitcoin wallets, software wallets and hardware wallets. Both are secure, but hardware wallets offer the highest level of security since they store your cryptocurrency on a physical device rather than an online connection. Basics of cryptocurrency trading. A market that never sleeps determines the value of Bitcoin second by second and day by day. Unlike most currencies, which do not have to deal with volatility issues, Bitcoin does since it is an autonomous digital asset whose value is established by an open market. Therefore, it is crucial for newbies to have a basic understanding of how crypto asset markets operate so they may traverse the markets securely, even on occasion, and maximize the benefits of their involvement in the crypto trading economy. Scale and complexity of Bitcoin trading can vary from a straightforward exchange for fiat money like the dollar to using a number of trading pairings to successfully ride the market and expand one's investment portfolio. Of course, a trader's risk exposure grows as a crypto transaction size and complexity expand. Let's first review some fundamental ideas. Structure of a crypto trade. A buyer and a seller participate in a cryptocurrency transaction. Someone will always benefit more from a trade as there are two competing sides, a purchase and a sale. As a result, trading is by its very nature a zero-sum game in which both winners and losers exist. Basic knowledge of how the Bitcoin markets function can be used to reduce potential losses and maximize gains. When a buyer and seller agree on a price, the trade is carried out via an exchange, and the asset's market value is established. Buyers typically set their orders at a lower price than sellers. The two sides of an order book are thus created. Cryptocurrency prices often increase when there are more buy orders than sell orders since there is greater demand for the asset. On the other hand, when there are more sellers than buyers, the price drops. Buys and sales are typically represented in distinct colors in exchange interfaces. This is done to quickly inform the trader about the market's condition at any particular time. You may be familiar with the trading maxim buy low, sell high. The adage does provide a fundamental illustration of the incentives of buyers and sellers in a marketplace, but it can be challenging to navigate because high and low prices might be relative. Simply, you want to spend as little money as you can while making a transaction. If you want to sell anything, you want to get the biggest return on your investment. Although this is typically sound advice to abide by, there is the additional consideration of desiring versus shorting assets. Going long on an asset, longing, is purchasing an asset and making money off of the asset's rising price movement. Contrarily, selling an asset with the goal to buy it back when its value drops below the level at which you sold it in order to profit from a price decline is known as shorting an asset. However, shorting entails the sale of borrowed assets that will be repaid later and is a little bit more difficult than this basic explanation. Reading the markets. The truth is that the market is just individuals buying and selling things. To the uninitiated, the market could appear to be some complicated system that only a professional could ever hope to understand. At first glance, trading cryptocurrencies could appear like a mysterious concept. But once you start to get it, the concept gets a lot clearer. The sum of all open buy and sell orders represents the state of the market at any particular time. In order to read the market, a trader must continuously look for patterns or trends throughout time and decide whether to act on them. Both bullish and negative market patterns are present overall. A bullish market, sometimes known as a bull market, is one in which price activity seems to be rising gradually. Due to the surge in demand, these price increases are sometimes referred to as pumps. When the price activity seems to be decreasing consistently, the market is said to be bearish or in a bear market. Due to the widespread selling that occurs, these price declines are frequently referred to as dumps. Depending on the time period you use, bullish and bearish trends can potentially exist within other more significant opposite trends. For instance, a little short-term bearish trend could develop within a larger long-term bullish trend. Price activity often makes higher highs and higher lows during an uptrend. Lower highs and lower lows are signs of a downtrend. When the price oscillates back and forth or stays within a range, the market is said to be consolidating. Consolidation phases typically occur when an item is cooling off after a rapid rising or negative trend, and they are easier to notice on larger time frames, daily charts or weekly charts. Consolidation can also occur prior to trend reversals, during periods of low demand, or when trading volumes are low. During this market condition, prices effectively trade inside a range. Technical analysis. Technical analysis, TA is a technique for forecasting price movement by examining historical market data, especially price and volume. Here are some fundamental macro and micro-level tools, though a trader could utilize a wide range of TA indicators, varying in complexity. Market structure and cycles. Traders can see patterns throughout years of varying price activity, just as they do within hours, days, and months of time. The market is susceptible to particular behaviors because of its basic structure. 4 major segments of the cycle can be identified: accumulation, markup, distribution, and decline. Traders will regularly adjust their positions as the market transitions between these phases by consolidating, retracing, or correcting as they see fit. The behavior of the bear and the bull differ greatly from one another despite existing in the same environment. A trader must be aware of their own role as well as the role that is now saturating the market. Technical analysis is essential for both positioning oneself inside this dynamic market and actively navigating its ups and downs. Chasing the whale. Price changes are primarily influenced by whales, or people or organizations with a lot of money to trade. In order to provide liquidity for an asset while making money in the process, some whales engage in market making, establishing bids and asks on both sides of the market. Whales can be found in almost every market, including those for stocks, commodities, and cryptocurrency. The instruments of the trade favored by whales, such as their preferred TA indicators, must be taken into account by a Bitcoin trading strategy. Simply put, whales typically have a good sense of direction. A trader can collaborate with these skilled movers to succeed with their own approach by anticipating the intentions of whales. Psychological cycles. It can be simple to overlook the fact that, for the most part, real people are behind these trades and that, as a result, they are susceptible to emotional behaviors that can have a major impact on the market when surrounded by a zoo full of metaphors. The well-known chart psychology of a market cycle shows this market feature. Despite the value of the bull-bear framework, the psychological cycle shown above offers a more thorough spectrum of market mood. The force of group mentality often takes hold, despite the fact that one of the fundamental trade rules is to leave emotion at the door. Fear of missing out, FOMO, is what is causing those who haven't yet positioned themselves in the market to climb from hope to exhilaration. Timing an exit before the bears take control and people panic sell requires navigating the valley between euphoria and complacency. Here, it is crucial to take into account high-volume price activity, which can reveal the market's overall trend. Given that the optimum moment to accumulate within a market cycle is during the depression that follows a sharp decline in price, the buy-low mentality is pretty obvious. The profit increases as the risk does. In the midst of the barrage of hot opinions and commentary from the media, chat rooms, or purported thought leaders, the challenge for the professional trader is to avoid letting emotion dictate their trading technique. Whales and other individuals who have the power to change the market's pulse frequently manipulate these marketplaces. Do your research and trade cryptocurrencies with conviction. Basic tools. To be clear from a macro perspective, one must be able to recognize market cycles and patterns. It is crucial to understand your place in respect to the whole. Instead of paddling aimlessly in the water and hoping for the best, you want to be the seasoned surfer who can spot when the ideal wave is about to come. But in order to decide on your actual plan, the micro perspective is also essential. Although there are many TA indications, we will only discuss the most fundamental. Support and resistance. The terms support and resistance, which refer to price barriers that frequently arise in the market to prevent the price movement from moving too far in one direction, may refer to two of the most frequently utilized TA indicators. The price at which the downward trend frequently pauses because of a surge in demand is the support level. Traders frequently purchase cheap when prices drop, forming a support line. The price level where the rising trend tends to stall owing to a sell-off is known as resistance. On the other hand, many cryptocurrency traders place bets on the price's direction using support and resistance levels, changing their strategies as the price level crosses through either of its upper or lower bounds. Traders can enter or exit positions once they have determined the floor and ceiling, which creates a zone of activity. Standard operating procedure is to buy at the floor and sell at the ceiling. If the price crosses these thresholds in either way, it indicates how the market is feeling generally. New levels of support and resistance frequently appear as the trend breaks through, thus this is a continuous process. Trend lines. Although traders frequently employ the static support and resistance levels depicted above, price movement typically trends higher or lower with barriers altering over time. A series of support and resistance levels may point to a stronger market trend that is depicted by a trend line. Resistance levels start to form, price movement slows, and the price is pulled back to the trend line while the market is heading upward. As they show a region that helps prevent the price from dropping significantly lower, the support levels of an ascending trend line are of particular interest to cryptocurrency traders. Similar to this, traders will monitor the series of dropping peaks in a market that is heading downward in order to join them together into a trend line. The history of the market is the essential component. Any support or resistance levels in the trend lines that come from them gain power over time as they recur. As a result, traders will keep track of these obstacles to guide their continued trading approach. Round numbers. The obsession on round number price levels by novice or institutional investors has an impact on support, resistance levels. It can be challenging for the price to rise above this point when a lot of trades cluster around a good round number, such as happens frequently with Bitcoin whenever its price approaches a sum that is evenly divisible by $10,000, for example. This position is known as a resistance. This regular occurrence is evidence that human traders are susceptible to emotional influence and frequently turn to shortcuts. If a specific price point is achieved for a Bitcoin, there will undoubtedly be a flurry of market activity and expectation. Moving averages. Traders frequently smooth out this data to produce a single visual line representation known as a moving average using a market history of support, resistance levels and the associated upward, downward trend lines. The moving average does a good job of following the peaks of resistance during a downward trend as well as the bottom support levels in an upward trend. A good indicator of short-term momentum is provided by the moving average when trading volume is taken into consideration. Chart patterns. Candlestick charts were developed in Japan in the 1700s as a technique to gauge how traders' emotions have a significant impact on price action in addition to pure supply and demand economics. Since it can include more information than the more straightforward line or bar charts, this market representation is one of the most popular among traders. There are 4 price points on a candlestick chart: the open, close, high, and low. What does this have to do with trading cryptocurrencies? Because of their rectangular design and the lines above and or below that resemble a wick, they are known as candlesticks. Depending on the candle's color, the price opened or closed at the widest part of the candle. The price range in which an asset is traded during the course of the candlestick's predetermined period is represented by the wicks. Depending on the timeline chosen, candlesticks can represent various time spans, from 1 minute to 1 day and beyond, and exhibit various patterns. Fundamental analysis. How then do we assess a specific crypto asset's potential, independent of or prior to its trading market performance? Fundamental analysis is the study of the underlying industry, technology, or assets that compose a certain market, as opposed to technical analysis, which involves analyzing market data to develop one's trading strategy. A trading portfolio for cryptocurrencies is likely to include Bitcoin and alternative cryptocurrencies. How can one tell if a financial asset is founded on solid principles as opposed to marketing hype, overblown technology, or worse, nothing at all? Considerations for fundamental study of new assets should include the following. Developers. Before making an investment in a cryptocurrency asset, it is critical to evaluate the reliability and competence of the developers. What is their history? What software projects have they previously launched? How far along are they in creating the token's underlying protocol? Since many projects are open source, tools for collaborative code repositories like GitHub make it possible to immediately observe this activity. Community. For projects involving cryptocurrency trading, community is essential. The majority of the power behind these assets and the technology that underpin them comes from the combination of users, token holders, and enthusiasts. After all, any new technology always has a social component. However, due to the high stakes involved and the frequent presence of amateur retail investors, the environment is frequently poisonous and riven with rivalries. Therefore, a constructive dialogue within the community is encouraged. Technical specifications. The fundamental technical requirements for a crypto asset, which should not be confused with market technical analysis, include the network's chosen algorithm, how it maintains security, uptime, and consensus, as well as issuance, emission features like block times, the maximum token supply, and the distribution strategy. A trader can ascertain whether such aspects support a potential investment by carefully examining the protocol stack of a cryptocurrency network and the monetary policy enforced by the protocol. Innovation. While electronic money was initially meant for use with Bitcoin, developers and business owners have not only found additional uses for the blockchain but have also created entirely new protocols to support a wider range of applications. Liquidity, and whales. A healthy market requires liquidity. Exists trust for the exchanges that support a specific cryptocurrency asset. What trading pairs are there, if any? Is the volume of trade and transactions healthy? Are there significant market participants, and if so, how do their trading habits affect the market? A new, creative protocol might already be in use, but it might not have immediate access to liquidity. As a result, establishing liquidity takes time. These investments are dangerous. You are effectively gambling that a strong market will someday develop around the project if volumes are low and there are few to no trading pairs available. Branding and marketing. Because most cryptocurrency networks lack a central person or organization promoting branding and marketing around their technology, there may not be a clear strategy or direction for branding. This is not meant to minimize the branding and marketing that do eventually result from a process. In fact, a complete picture of how specific actors convey value propositions to the general public may be obtained by comparing the marketing initiatives of core developers, businesses, foundations, and community members. Infrastructure. This characteristic of a cryptocurrency exchange can be viewed as the expression of a project's technological requirements. What is the actual physical embodiment of the protocol under consideration, despite what is said in white papers or presented at conferences? It is important to identify the stakeholders, including the developers, block validators, retailers and users. Furthermore, it is essential to comprehend who the network's stewards are, what they do to secure the network, mining, validation, and how power is divided among them. On-chain analysis. Since blockchain technology underlies all cryptocurrencies, a brand new sort of analysis that depends on data from blockchains has emerged: on-chain analysis. Analysts are able to make precise qualitative and quantitative observations about the strength of a cryptocurrency's blockchain network and its price dynamics in a range of markets by examining supply and demand trends, transaction frequency, transaction costs, and the rate at which investors are buying and selling a cryptocurrency. Due to the analyst's ability to correlate numerous macro and microeconomic events with the actions of investors, which are immutably recorded on the blockchain, on-chain data also offers important insight into investor psychology. Analysts search for abnormalities in the buying, selling, and holding patterns of cryptocurrencies in relation to market rallies, sell-offs, regulatory developments, and other network-oriented events. This is done in order to predict anticipated price changes in the future and investor responses to upcoming occasions like network improvements, halvings of the coin supply, and developments in conventional financial markets. Trading crypto is risky. The control of risk is another important component of trading. Knowing how much you are willing to lose on a cryptocurrency trading if it goes against you is crucial before you join a trade. This may depend on a variety of elements, including your trading money. One might, for instance, decide to only risk losing 1% of their total trading capital overall or each trade. Simply put, trading is a dangerous activity in and of itself. Any future market action cannot be predicted with accuracy. In the end, it's crucial to make your own decisions based on the material at hand and your own judgment, as well as to make sure you have received the appropriate education. Additionally, based on tastes, personalities, trading capital, risk tolerance, etc., trading techniques can vary greatly from person to person. Trading entails a great deal of responsibility. Before choosing to trade, everybody considering it must assess their own circumstances. Thanks for watching. Kindly like this video, subscribe to our channel and get notified for our next cryptocurrency investing tips.